Welcome to FT Markets. The authorities in Saudi Arabia issued a statement on Monday saying that the 30-year mandate that pegs its real currency to the dollar was not under threat. But as oil prices continue to fall and the Saudi economy comes under strain, that currency peg is looking vulnerable. With me to discuss its prospects is Peter Kinsella, Head of Emerging Markets Research at Commerzbank.
Hello.
Peter, welcome to the FT.
Thank you.
You have a view that the currency peg is unsustainable.
Certainly, yeah.
Why?
Yeah, well, basically, what we have at the moment is a combination of a very, very strong dollar and a strengthening dollar and a significant fall in the oil price, which basically brings into the question the overall sustainability of the peg. And basically, as the lower the oil prices go, the more likely it is that we see sort of some readjustment in the pegged exchange rate.
Okay, and so the statement from the Saudi authorities made direct reference to market speculation, and our first two charts put that into context.
Yeah.
Just talk us through the Saudi interest rate swaps, which has been happening.
What we're basically seeing at the moment, pretty much since I would say the beginning of last year, but in particular the second half of last year, is a very notable increase in shorter term swap rates, so over 1 year and 2 year tenor. And that indicates one of two things. It indicates either we're seeing capital flight from the Saudi banking system, or it indicates that markets think the Saudis will have to increase interest rates in order to maintain the peg with the dollar. One of the two.
And the second chart is about the forwards
Certainly.
pricing. Yeah.
And indeed, what you're seeing here is forward pricing, and just on the 12-month forward, has really skyrocketed in the last number of weeks and months, such that current prices forward prices deviate by roughly about 2% or thereabouts from the spot. The reason that's a problem is that if the exchange rate and if the spot, the pegged exchange rate was a truly credible policy, then by definition the forward wouldn't diverge too much at all from the spot. But what we're clearly seeing now is that the market is, rather, I would say, sceptical about the ability of the Saudis to maintain the peg.
Okay. Well, clearly what's been going on also is that the fall in the oil price, which we'll see in our third chart, is the big major stumbling block. And the third chart illustrates this. And what's also been going on is the Saudis been pushing down that oil price quite deliberately.
Yes, they have, and that's that's a well-known strategy. Obviously, the Saudis are trying to knock out the so-called higher-cost producers elsewhere in the world. So this is
the American shale gas.
Exactly,
shale
it's a broader play for sort of market share.
Yeah.
Now, the problem with that is as follows: is basically that if the Saudis come along and as I said, the longer the prices remain very low, the more and more the peg comes into question. However, if the Saudis say, okay, if they place total precedence upon maintaining the peg, then by definition, in order to maintain that, they want to see slightly higher oil prices. But if they indicate that higher oil prices are along the way, that basically gives a signal to higher cost producers that happy days are here again. So really what the Saudis have got themselves into is a classic catch-22 situation.
And let's look at our fourth chart, which is about the dependence of the Saudi economy on oil. I suppose my question is, what happens to the Saudi economy if the peg goes? Talk about the reliance on it.
I think there's a couple of points really. Well, the first point would be that the Riyal sort of denominated oil revenues would obviously increase pretty substantially, and what that basically means is that they wouldn't have to undergo as severe austerity or budget cutbacks as they would have to if they maintain the peg in its current condition. What we see at the present is that the Saudis are saying, okay, we're going to engage in budget cuts over the coming years. As we saw in the Eurozone, sort of austerity and fiscal cuts are by no means easy, right? So the politics involved here, particularly in Saudi, are a bit more difficult as one might imagine. The break even on the oil price for Saudis in terms of their social outlays is around $98 per barrel, right? And as things stand, we're closer to $30 a barrel. So it basically highlights the fact that this potentially can get worse before it gets better. In the event that they actually do allow the peg to collapse or even to repeg at a slightly higher level, clearly what you'll see is that imports will decrease pretty substantially, and the price of those imports that they have will increase. But the main, I would say, benefit to them would be that the real revenues from sort of the oil sales, they would increase.
Okay, but for the moment, the Saudi kingdom is saying that they are very happy to keep supporting this peg, and that is going to eat into has been eating into their reserves, hasn't it?
Indeed, it has been, and at the moment, the markets thinks that they've got roughly about 4 to 4.5 years of import, of cover from their FX reserves. However, this logic is a bit self-defeating in my opinion, The decision to actually, break the peg or to repeg at a higher level, that comes long before sort of 4.5 years worth of reserves have been eaten up. Put it this way, if Saudi reserves were to decline by 100 or 200 billion in the coming 6 months, at that point, the remaining reserves sort of increase in relative value. So the idea of having 4 or 4.5 years, that's kind of nonsensical. It's actually a lot less in real terms. And that's really what we see. Indeed, what we saw last year from other pegged regimes or managed FX regimes was that the presence of very large FX reserves didn't prevent
Azerbaijan, Kazakhstan,
Russia, etc. It didn't prevent severe weakening of the exchange rates for that very reason.
So you could actually see the peg coming off quite soon.
I wouldn't say soon. I don't think it's anything imminent per se, but I think that it's definitely a tail risk for investors. And I think from an investor point of view, it's really an asymmetric risk, which is entirely in an investor's favour. If you buy the forward now in 12 months, it costs you maybe 2%. Potential repay could be anything in the order of 30 to 40%. So you see the logic basically. There's very little downside for investors from taking this position.
Peter, thank you very much.
You're very welcome.
The peg is here for the moment, but in terms of where the oil price is going, and that's something that the Saudi is controlling and trying to keep the peg, perhaps something has got to give.